What is up, guys? It is Joe Caruso here with an exclusive video for a 15-minute scalping strategy that works especially well on US30. Now, in the month of October, I just started utilizing this strategy myself, so I wanted to show you some of the trades I took and how you can utilize this very simple strategy for yourself. The basis of the strategy is taking 15-minute shark fins and 15-minute divergence trades, as well as utilizing 1 hour, 30-minute, and or 4 hour areas of confluence to coincide with your 15-minute shark fins and divergence. So essentially, you are taking lower time frame entries. Your 15-minute is always going to be your entry time frame. Now, there will be instances where price hits a 4 hour area of structure, a 4 hour support, a 4 hour resistance. But on your 4 hour, your TDI doesn't give you anything. So it's not necessarily a 4 hour trade, but it may touch a 4 hour area of confluence. Now, when you scale down and you notice on the 15-minute, you have a shark fin forming, that is a valid trade because it lines up on the 4 hour. And alternatively, you can save yourself from losses by paying attention to that higher time frame. And there may be some examples of trades where they give a 15-minute shark fin, but on your 1 hour or 4 hour, they're directly going against a move, such as a major area of structure. So for this week, and this was the last week of October, there was a move that happened on Monday, which I did not end up taking. But Monday of this week, there was a 15-minute shark fin that turned into divergence, and price rose off of that. Now, the move I took was on a Tuesday. So if you notice, I drew up a trend line, which Monday going into Tuesday, we were following pretty well. So when price came down, created a 15-minute shark fin at the psychological level of 33,000. Quarterly psychological levels are when the last three digits are 000, 250, 500, and 750. This is a very vital factor for US30 in particular. US30 loves those quarterly, you could call them quarterly levels, institutional levels, or psychological levels. So I noticed that we had a 15-minute shark fin at a trend line plus psychological level, and I had entered the trade. Now, my stop loss was about 70 points. Reason being, if you look to the left, I noticed that we had structure. So when I notice that there's structure to the left, I'm going to use that recent structure for the stop loss. Hence why my stop loss was here and not all the way down here. Because this is a 15-minute trade, 140-point stop loss would be way too large and it would destroy the risk to reward ratio, making the trade not even worth taking, right? So I kept it at a 1-to-3. What did I target? I targeted structure in the opposite direction. So I'm taking my entry based on 15-minute shark fin or 15-minute shark fin turned divergence. To figure out my stop loss, I'm looking to the left and looking at nearby structure. Again, if it completely distorts my risk to reward, makes it worse than a 1-to-2, I will not take the trade. The goal is to get between a 1-to-2 and a 1-to-4. The only times it will be better than that is if the trade lines up on multiple time frames, especially higher time frames. My trade management is when the 15-minute 50 gets hit, you put your stop loss to break even. So yes, this strategy requires a bit of management, right? But it is very simple and very easy to use, and almost once a day, there is a 15-minute move that lines up. Not every day is a move you want to take, because again, you do want to consider what's going on the higher time frames. On your 1 hour, on your 30-minute, daily is not very relevant to this strategy. This strategy is particularly pertaining to the 15-minute with slight emphasis on the 30-minute and the 1 hour. You could even say the 4 hour, but these moves are relatively quick. Same day in, same day out, usually out by the end of the day. In terms of duration, this trade that was on a Tuesday got in Tuesday afternoon at 1 o'clock, and I was out by 1 o'clock. Hold on, let me make sure I get the time right. It was about 6 hours, this trade. The following day, I took a trade off the exact same parameters as the day before. So look, 2 days in a row at the exact same spot, the exact same setup. 15-minute shark fin, because a shark fin again is when your TDI comes outside of your Bollinger Band on the TDI, which is the blue line, when price comes outside of that blue band and it is below the dotted 25 level for a buy, or if it's a sell, it has to be above the 75. Both of those must be present. If it is just outside of the blue band, but not past the 25/75 level, it is not a shark fin. And if we look at this example right here that I'm highlighting, this is above the 75 level, but not outside the blue band, hence not a shark fin. So that was not a shark fin sell because it did not reach the criteria. If you look at the first trade I took, hit the 25 level and outside the band. Trade on Wednesday, outside the band and under the 25. Now, if we look at the TDI for the trade that was taken on Thursday, outside the band, above the 75. Tuesday, Wednesday, Thursday, 3 days in a row, 3 trades, they all played out. They all utilized the exact same management. Entry on a shark fin, use the 15-minute 50 moving average as my protection. So I have for this trading plan, I told you what your entry is. Your stop loss should always be between 40 points and 70 points, I want to say, just because this is 15-minute and it's specifically on US30. That's what it almost lines up to be. Take profit on almost all of my trades was close to 200 points, sometimes a little under, sometimes a little over. Stop loss was about 70 points on average for all of them. Risk to reward was 1 to 3, 1 to 3, 1 to 2.5. Again, as long as it's greater than a 1 to 2, I will take it. Enter the trade on a shark fin. Price hits the 50 moving average, put stop loss to break even, so it's a risk-free trade. Just in case it reverses at the 50 and comes back, it is protected. This trade got hit within about 1 hour, full take profit. So the day before, it took like 8 hours. Next day was about 1 hour. Day after that, this also happened within about an hour or two. Shark fin, trend line, and a moving average. Pretty good combination. Was an area of structure as well. And my take profit was, again, structure. Where's nearby? So since this one was a sell, I looked at where was nearby support. I exit right at that support level, slightly above. Vice versa for those buys. I'm buying. Where am I exiting? I notice nearby structure, nearby resistance. I exit right underneath it. That is the safest exit. Notice if I tried to target a little bit higher, it would not have hit. It would have reversed. So you have to know where you're getting in, where your stop loss is, how you're going to manage your trade, and where you get out. So that was, in summary, that week. There are certain instances which, if you are against a breakout, which this, I'm going to point out the shark fin with an arrow. This was a shark fin you would not want to take. Or vice versa. I mean, both of these, essentially. This one was worse because here is a shark fin that is in prices obviously breaking to the downside, breaking through support. So it's about as counter trend as you can get. Not the best one when you're looking at, you're not in a form of consolidation, which we were consolidating the week where I drew these 3 trades. It was a consolidation week, very easy to trade, tops and the bottoms. Essentially, if there's a shark fin, if there's divergence, you enter. If not, you don't enter. When price is running, you want to be going with the trend. 15-minute shark fins going with the trend, 15-minute divergence and hidden divergence going with the trend will play out roughly 90% of the time. This strategy will still have an extremely high win rate, especially if you utilize the proper risk management and trade management. So if you took this shark fin over here, remember the rule, you enter, okay, it's a shark fin. If there's not anything else for you to enter off of, let's say maybe you didn't get in this one because of where it was at. You don't always know when that shark fin is going to play out. You need something else like structure or a trend line to take it off of. If you got in, you would utilize the trade management plan. Hits the 50 on the 15-minute, which is the blue line. put stop loss to break even. So when it comes back down, it's a break even. This one, I would hope that you would still take the break even, because notice that instead of hitting the 50, it just missed. But what did it hit? Structure. Not just this structure, but even looking at this. There were several reasons at which it would make sense in this area to put your stop loss to break even if you were going against the trend. So if you protected it, you would have been protected on both of those trades and not taken a loss. Maybe you took a loss on one if you were not very wise about the trades you were taking. Like I said, you do want to make sure that you have a trend line or a moving average or solid structure to take your trade off of. Look over here. This is a 15-minute shark fin turned divergence. So you had your shark fin right here at this arrow, but then price came up and gave the obvious entry, right? So if I draw this one up, entry on the moving average, we're going to look to the left because that structure from the previous trade lined up perfectly with this spot. Now, if we do our stop loss, you're going to have to look to the left, right? We talked about having to look to the left. The area that I had the stop loss at for the first trade, this trade actually lines up really well with going with the exact same coordinates, because the entry is at the same spot and the same stop loss I picked for that trade still holds true for the next trade. So you're going to end up with a stop loss in roughly the same area. Exit would be right here. Because remember our plan, where do we exit? Nearby structure. If there's nearby support, we don't do this because you don't know if it's going to go there. You go like, not even here, this is pushing it to get it right on the dot. You want to go slightly above. Notice, again, our risk to reward is about 1 to 2.5, which is pretty standard with this strategy. That you would have, when it hit the 15-minute 50, you put your stop loss to break even. And then you're protected no matter what happens. But it ended up hitting take profit. There was nothing to worry about. There was actually a shark fin to the upside going in the other direction. But again, if you aren't able to take the trade, let's do this. If I draw a box like this, I can formulate an area of structure. I'm going to draw this entire box, right? So let me see. Was it possible to get a trend line cutting through this area? It looks like it would be a rough stretch to try to get that. Not really sure if we could. It'd be a little bit of a stretch. Not sure if we would have been able to pinpoint this one. You do have a quarterly level of 32,750. That quarterly level is just underneath price. I do see that there is some structure here, but let's go off of having not the greatest entry. Let's say you took this because you noticed it was a 15-minute shark fin, had, like I am right now, a little bit of a hard time finding something else besides this minor structure that lines up. This zone, yes, I would say makes sense, but I'm not too sure if I would take it at that exact. Where in here I would take it at. I don't think I would have caught the very bottom. Let's say we got in at a candle closure up here. Your stop loss on this trade, you would have to take into account, because this is a late entry, you're going to have to include a wick. You're going to have to take into account this box, which I was drawing up. So this trade would have a slightly larger stop loss because of that, because the placement wasn't the greatest. But our plan is same as always. When it comes up and hits the 50 moving average, you put stop loss to break even. So now there's no risk on your trade. And your target would be the structure up here in this area. And considering that you already took a trade off this area and it is solid structure, you are not going to try to hold past that. If anything, you are most likely going to even exit at the moving average. And if that essentially gives you a 1 to 2, that is perfect. Take it. Get out. Don't just take my word for this. You have to do some of this back testing for yourself. Look on your 15-minute chart, look at shark fins, look at divergences, draw them all up. When price hits the 50 moving average, you put stop loss to break even. You target nearby structure. This is going to work out more than half the time, and you should always be hitting 1 to 2 or better. So essentially, it is a strategy that will play out pretty well. And it is definitely a profitable strategy. There's no doubt about that. I've done enough of the back testing and I've done enough of the live trading with it to see that it rarely misses, unless you are very completely countering the trend, countering an obvious trend, an obvious breakout on some higher time frames. It will work out pretty well, which is why when you do back testing, you are going to do it very thoroughly, right? You're not just going to skim 1-2 trades. You're going to want to go through several years of data and gather 50 to 100 trades. That will give you a basis point and help you understand the entries, help to tweak the entries a little bit, perfect the stop losses, make sure you got the entries down pat. It will help you with all of that. The back testing is what's going to really help you see for yourself. So I did want to share with you those trades that I had taken, and again, even went to the next week and showed a couple more. There are some weeks where you're trending so hard, there's not really much of an opportunity. Other weeks, you have a trade almost every single day. So thank you guys for watching this 15-minute scalping video. And stay tuned, there will be plenty more videos like this. Thank you.